Welcome to The Explainer. Today we're diving deep and decoding the kinds of sophisticated chart patterns that professional traders use to get a real edge in the markets. We're going to see what they see and hopefully understand how they do it.
So, it's the big question, right? Have you ever looked at a stock chart and just seen, well, noise? A bunch of random squiggles going up and down? A professional trader and institutional trader, they see a story playing out. It's a story of accumulation, where they're quietly buying, and distribution, where they're carefully selling. In this explainer, we're going to learn to speak their language.
And this quote, this really gets to the heart of it all. Information asymmetry. It just means that not everyone is playing with the same information. While most people are focused on the common, everyday patterns, the smart money is operating on another level, using formations that pretty much fly under the radar. These advanced patterns, they're like the footprints they leave behind in the snow. Okay, so if we're going to follow those footprints, we first have to understand how they think. This isn't just about looking at charts. It's about a completely different mindset, a different approach to the entire game. This slide really paints a picture, doesn't it? It's a tale of two traders. Over on the left, you've got the smart money approach. These are the big institutions. They have patient capital, meaning they can wait months, even years, for a perfect setup. Then on the right, you have the common retail traps. Things like impatience, that fear of missing out, or trying to force a pattern onto a chart that isn't really there. And of course, emotional decisions. The goal for any serious trader is to move your mindset from that right column over to the left. All right, we've got the mindset down. Now for the really fun part. Let's get into the patterns themselves. Think of these as the specific signatures, the dead giveaways that signal major institutional buying or selling is happening right under the surface. First up, we have an absolute superstar of a pattern, the cup and handle. This is a true classic for a reason. And this isn't some pattern that forms in a day or a week. No, this is a powerful formation that shows months of quiet, steady accumulation by the big players right before a stock is ready to make a huge move higher. Now, the devil is in the details here. You can't just see any curve and call it a cup. It has to be a gradual, U-shaped bottom, not a sharp, V-shaped recovery. And the handle, that's the magic ingredient. It's a short, slight pullback where the trading volume just dries up. That's the tell. It shows that anyone who is easily scared, the weak hands, they're gone. And then the breakout happens on a huge surge of volume. That's the confirmation that the big players are now in control. Next up, the diamond formation. Now this one's a bit of a unicorn. It's rare, and that's precisely why it's so incredibly powerful when you do spot it. It often shows up at a major market top or a major bottom, and it signals that the entire trend is about to reverse course. So what makes a diamond a diamond? It's this really unique dance between volatility and volume. First, the price swings get wilder. That's the expanding part. Then they get tighter and tighter, the contracting part. Volume is super high during that expansion, and then it just fades away during the contraction. The final breakout, whether it's up or down, that's what signals the new trend with some serious conviction. And for our third pattern, we have the rounding bottom, sometimes called a saucer. And if you thought the cup and handle was about patience, well, this one is the absolute masterclass. This represents a slow, deliberate, methodical shift in market sentiment from total pessimism all the way back to optimism, and it can take many, many months. You see the big theme here? It's all about being gradual. There is no sharp V-bottom snapback. The price just slowly, painfully grinds its way higher as sentiment gets a little better each week. And it's often backed by a real fundamental improvement in the company. The volume pattern is key here. It's almost dead at the very bottom, and then it slowly starts to pick up as more and more buyers get convinced and step in. Okay, so spotting these patterns in the wild, that's step one. And it's huge. But let's be real, professionals aren't just winging it. They have a system. It's all about turning that moment of recognition into a disciplined, repeatable process you can use over and over again. And this is that process. This is the checklist. And notice something really important. Pattern screening is just step one. It's just the start. All the real work happens in the other 7 steps, things like confirming the volume, checking the company's fundamentals, and most important of all, figuring out your risk and your exit plan before you even think about placing a trade. That discipline, that's what separates the pros from the amateurs.
Now, this is where it gets really interesting because we actually have some data on this. This chart shows you the historical performance. Look at the cup and handle, an incredible success rate, historically between 85 and 90%. Then look at the rounding bottom. A little less reliable, sure, but it has the potential for the biggest average move. This kind of data helps a professional trader weigh the probabilities and pick the best setups.
Okay, let's pause, because we need to talk about what is, without a doubt, the most important part of this entire explainer. What happens when you're wrong? What happens when a good pattern goes bad? Because even the highest probability setups can, and do, fail. Professionals don't hope for the best, they plan for failure. I want you to really look at this number. 2 to 3%. Burn it into your brain, because this single number is what separates traders who survive from those who don't. It's the absolute maximum a professional will risk of their entire portfolio on any single trade. It's not a suggestion, it's a non-negotiable rule. It guarantees that no single bad trade can ever wipe you out. So what can go wrong? Well, a few things. You might get a false breakout, a little head fake where the price pops up on weak volume and then just collapses. A surprise news event could come out of nowhere and completely destroy a beautiful setup. Or you might find the perfect bullish pattern, but it gets steamrolled because the entire market is in a nosedive. Context is absolutely everything. So how do the pros protect themselves? It's not about gut feelings. It's a set of hard and fast rules. You set a stop loss at the exact point where the pattern is proven wrong. You calculate your position size based on that stop loss. You have a plan for taking profits. And if the fundamental reason you bought the stock changes, you get out immediately. No questions asked. It's all mechanical and disciplined. All right, we've gone through a ton. The mindset, the patterns, the framework, the risks. Let's zoom out now and put a bow on this and talk about the real philosophy behind this whole approach. At the end of the day, this is what it all comes down to. This is the big secret. These patterns are not a crystal ball. Nobody, and I mean nobody, can predict the future. The entire goal here is to simply identify the footprints of the big institutions and align your own trades with what they're already doing. You're not trying to be a hero. You're just trying to ride the powerful wave they create. And that really leaves us with one final, crucial question. You've seen the patterns. You understand the professional framework. But do you have the one tool that makes it all work? These setups, they take weeks, sometimes months to form properly. So the real secret weapon isn't some fancy indicator on a chart. It's the patience to wait for that perfect setup and the discipline to act on it without emotion. The question is, do you have it?